We're here to talk a little bit about taxes. Everyone loves to pay them, right? Everyone, can't wait to line up at, Mike Karu's door and give him all his information and say, how much do I owe, right? I mean, that's that's better than Christmas. It's better than Hanukkah. But today we're going to kind of talk about a little bit about how to make that time frame, right, a little bit more palatable and a little bit more advantageous towards yourself. So we're going to talk about in our opinion, the top 8 tax tips going into your tax planning, or I should say top 8 tax planning tips going into tax time and things that you should be considering and doing before the end of the year. So we do have Mike Karu on the line. He is a CPA located in Livingston, New Jersey. Obviously, he's been around quite a bit of time. I'm going to say maybe only, 5 or 10 years or something like that, right? Because he's still only 25 years old. But he's a partner with Levine Jacobs. They're located right on Eisenhower Parkway in Livingston. So firm that's been around for, I think, well over 20 years.
70.
How many?
We were actually founded in 1952, so we'll have our 70th birthday next year.
See that? I said well over 20 plus years. There you go. So, I brought him on the line here to kind of answer any of the in-depth questions. As you know, Lou DaCosta and I are certainly not CPAs, and we certainly are not tax experts, and we always defer to the experts when it comes to in-depth questions and analysis. But we certainly know enough to be dangerous, and we can give some guidance along the way. But I wanted Mike here on the line to answer any of those difficult questions that we can't answer, and then to maybe, prove us wrong if we're saying anything incorrect, right? So I'm gonna share my screen momentarily here. But we have a small group, so if there's any questions that any of you have, by all means, do not hesitate to stop us along the way and interject those questions. I mean, being that there's only 5 or 6 of us, I think that, obviously being as interactive as possible will make it, better for everybody. All right. So everyone should be able to see my screen now, correct? All right. All right. So as I said, top 8 tax tips going into year end. What should we do? Number 1, many of you may be, itemized. Many of you may itemize your tax return, and some of you may take the standard deduction, right? So for those in this room that do itemize, which most of us probably do, because I know most of the individuals in this room are business owners, it's important to understand that there are increased standard deduction amounts that came into play a couple years ago. So you should always evaluate where you are, evaluate your numbers, and determine whether or not it is more advantageous to continue to itemize or potentially change and utilize the standard deduction. The standard deduction for 2021 is $12,550 for individuals and $25,100 for married couples filing jointly. It's always going to be easier to file utilizing the standard deduction, but the reality of it is, if you are a business owner and you do itemize, that certainly may be more advantageous. Mike, do you have any?
Understand there's a difference between being a business owner and taking expenses that are business related, which would go on to Schedule C if it's a sole proprietor, or onto the business tax returns, whether it's a partnership return 1065 or a corporate return 1120 or 1120S, the S for subchapter S, and that passes through as well. So those really are completely different than whether you take a standard deduction or you itemize. The standard deduction, it is what it is. Here's your number, you to get the deduction. To itemize, you have to have certain areas which total an amount greater than the standard deduction. Otherwise, there's no point. Of course, there is a difference for people who are married filing separately. If one elects to itemize, the other must itemize. Same thing. If one elects to take the standard, the other must take the standard. And it's kind of whoever files first wins. Within the itemized deductions, there's a $10,000 cap on taxes. That's local and state taxes. So whether it's sales tax, real estate tax, the New Jersey gross income tax, that's all capped at 10 grand. The next piece would be mortgage interest. And there are some limitations on that. If you have a new mortgage over $750,000, there's a cap as far as how much you can deduct. But on smaller mortgages, you could deduct the interest on that, plus the interest on a vacation home. And for anybody who likes boats, a houseboat or a boat that has sleeping quarters is a vacation home. So it does count. Okay. The third area would be charitable contributions. And that's obviously made by cash, check, credit card, or non-cash. Now, non-cash contributions are interesting because it could be, clothing that you bring over to Goodwill. You can donate a car. You can donate artwork. Anthony, I'm sure that you and Louis have seen, your clients make contributions of appreciated stock, which is a whole, I don't know if you have that anywhere in your list, but it is a truly advantageous way of not only getting a charitable deduction for the fair market value of that security, but not having to pay the capital gain on it. So using a really easy example, if somebody bought 100 shares of Home Depot stock years and years ago at $20, it's now trading around 400, give or take.
Yep.
So you say, oh, I'm going to give that 100 shares, which only cost me $2,000, a lot of years ago, to my favorite charity, and I'm going to get a $40,000 deduction for it today. And I don't have to pay the capital gain on that 38 grand. So it's a real benefit to do that as well. So you can look at appreciated assets. And again, if you get an outside appraisal, which is necessary for anything over $5,000, that's, again, appreciated stock is not, because that's that information is readily available. But artwork, other collectibles, you want to donate that boat that you had, now you're buying a new one, you could do that. A car. There's all kinds of things that can be done to get these non-cash contributions. And one of the things that we recommend is to bundle your contributions. So, if anybody goes to church or to synagogue on a regular basis, and you say, okay, I'm going to give, $100 a week, to my religious organization. Well, you can do that, or you can say to them, look, on January 1st, I'm going to give you a check for, $5,200, $100 a week. And then you do the same thing on December 31st for the following year. You've now put everything in one, so you've got 10-4 in one year instead of 5,200 in each, because that 52 may not be sufficient to get you to the itemized deduction. So, especially for people who don't have mortgages, you would need charitable contributions of $15,100 or more. So it may or may not happen. The other area is medical expenses. So, with what we're all paying for health insurance, that's a pretty good kick right there. But there's a 7.5% reduction based on your adjusted gross income. So if your AGI is only $100,000, you would lose the first $7,500 worth of medical expenses. So again, we tell people try to bundle those if you can. So, if you need new eyeglasses and you've had a lot of medical expenses, get them in the current year. If you haven't, push it into the next year. But again, try to bundle the expenses, both charitable and medical, into 1 year or the other. The last little thing on there with charitable contributions, even if you take a standard deduction, you can take up to $300 per person or $600 married filing jointly for cash, check, or credit card contributions made during 2021. So it's just a little bonus that the government threw in. All right. I'm done on that one. Back to you, Anthony.
There you go. So you kind of stole the thunder for number 2, right? Share to love, talking about charitable contributions. Individuals claiming a standard deduction can write up to $300 off on charitable cash contributions. If you're married filing jointly, $600. For those that are more, even more charitably inclined, as Mike said, potentially itemizing may make some more sense. But maybe you just don't know what charity you want to give the money to. Well, the beautiful thing is, you don't, with the advent of donor advised funds and and charitable remainder trust funds, you don't need to decide who which charity the money goes to right now, right? I mean, we have options that enable you to put money into a donor advised fund. And basically, it's like running your own foundation that enables you to give money out, whenever you see fit, right? So if you wanted to put $10 or $15 or $20,000 into a fund today, you take that deduction today. You can give the money out, tomorrow, next year, 5 years from now. It doesn't matter. It's a beautiful thing, and it's a way to obviously to be philanthropic over your lifetime. One that everybody talks about: harvest your losses. So this is something that we look at doing almost on a daily basis, right? I mean, it's not just something that one should do in December alone. It's something that one should consider doing all year long, right? Picture this: you have an investment that's just a lemon. It's a loss. It's something that you believed in a long time ago, but never seems to go, never seems to move forward. It always stays in the red in your portfolio. What you may or may not know is you have the ability to use that loss to your advantage. You can write off up to $3,000 a year of ordinary income against any losses that you realize. If you have greater than $3,000 in losses, you can carry those losses forward and use them next year. And you can certainly utilize losses greater than $3,000 to offset any gains that you may have in other positions in your portfolio. So if you're not doing this and this alone, you're making a mistake. I believe I read a statistic a couple years ago that said tax loss harvesting alone can contribute an additional 1 to 1.5% alpha or return in your portfolio per year, right? That's a big number. So harvesting losses, again, something that should be done on a pretty frequent basis. At the very least, certainly that should be done in December.
And again, just Anthony on that too. We're talking about non-retirement accounts, not retirement accounts.
Correct. Obviously, in non-retirement accounts, right? So good segue into.
Let me say one thing you do have to look. There are people who really love a stock, but it's gone down in value, and they say, "Oh, sell it, but buy it back in my portfolio." There are wash sale rules, and Anthony and Luis are very familiar with them. So, you just, if you plan on doing something like that, be smart.
Yeah, be smart. Be smart and be patient, right? Be smart and be patient.
One other thing, just with where it says share the love. One other easy thing on there. There's a lot of people, because of the higher standard deductions, who no longer will itemize deductions, but they still want to make charitable contributions, right? So, one of the things that I've done, that I'll tell you, it's have the contributions done by a family member. So for those who have adult children who may not be itemizing, you say, well, I can't itemize. So here's $300, make the contribution to X charity. And then they do it, they get the deduction. So just, it goes under the every little bit helps. And while it may not be a lot of money, if it saves, $50, $75, why not? Better in our pockets than the government.
That's right.
So, okay. Now, with the harvesting losses, and again, Anthony and Lewis, understand this completely. Losses offset like-kind losses, and so what happens is you match short-term losses with short-term gains, and then long-term losses with long-term gains. Then the two merge together to indicate whether you have a long-term or short-term loss in its entirety. As I said, the $3,000 limit, but the carry forward is what matters. So again, long-term gains are more advantageous tax-wise than short-term gains. So one of the other things, while they're harvesting the losses, they're also trying to maximize your gains. And the criteria for long-term is a year and a day. And I would tell people, never make the mistake of thinking it's a year and selling a day short. That gets expensive. All right, next.
So, and Louis made a good point, right? The harvesting losses is applicable to non-qualified or non-retirement accounts, but I'm sure most individuals in this room have a retirement account, whether it's a 401k at an employer, whether it's a individual 401k within your own business, whether it's a SEP IRA, doesn't matter. If you're not, putting in already maxing out on those, on those plans, you're missing the boat and giving up quite a bit of money, right? I mean, it's, basically, contributing to a retirement account is like moving money from your left pocket to your right pocket, and eliminating or reducing what you're giving to the IRS. So if you're not already maxing out on those plans, or you're not receiving the match that your employer provides, it's something that you should absolutely consider and look at. And certainly, in December, you have more than, a couple more paychecks left to do so.
Yeah, I don't know if you have the backdoor Roth on your list.
Mm-hmm. We do.
Yeah. Okay. Then.
We do.
Okay.
Yeah. So we will certainly talk about that, a little bit later on. So, on top of the retirement plan contributions, there are, if you are a business owner and you are already maxing out on your, SEP IRA or your individual 401k, and you still want to put more money away, and cash flow is there are more extravagant plan options to consider that enable you to put away a considerably more, larger amount of money. Plans like cash balance plans, defined benefit pensions, et cetera, et cetera. These are options that allow you to defer, hundreds of thousands of dollars today for retirement in the future. So just something to consider. Minimum distributions are back for 2021. So, be aware of this. If you have beneficiary IRAs, obviously, no one in this room is over the age of 72, but if you have relatives that are, be aware that minimum distributions are required to be taken. Okay. This is not necessarily a tax saving tip, but this is a, penalty prevention tip when it comes to taxes, because the penalties for not taking RMDs are pretty steep. Okay. It's 50% of what your RMD would have been. So if you have inherited IRAs and you did not take an RMD last year because it was deferred due to COVID, just understand that they are back in effect for 2021 and beyond. If you know individuals that are over the age of 72, please be aware that you have about 4 more weeks to take that required minimum distribution. All right. Give it away. Okay. So this is similar to that of charity, but in a different fashion, right? Individuals can give up to $15,000 a year to any other individual gift tax free until obviously December 31st. Okay. So if you're giving money away to your child and your child is married, you can now give away up to $30,000 a year. Or better yet, maybe you have grandchildren. Okay. and maybe you want to help your grandchildren pay for college, you have the ability to give away $15,000 per year, and you have the ability to accelerate that gift for 5 years. So what that means is individuals have the ability to give away up to $75,000 per child or grandchild into a 529 plan. And recently passed here in New Jersey, if you are under a certain income level, you would receive a $10,000 deduction on those contributions to that 529 plan. So again, you have the ability to gift $15,000 a year away to any individual for any reason, any purpose. You can accelerate those gifts into a 529 plan, and you can receive deductions for money going in to that 529 plan. So that is something new for 2021. Mind you, any gifts that you make over the $15,000 level would come off of your lifetime gift and estate tax exemption. So this is an estate tax, reduction, strategy for 2021.
Actually, it's 2022. One second, Jeff. It's actually 2022. The law was passed in 2021, but it's effective for January 1, 2022 and forward for the deduction there. Also, remember, it's not just $15,000 to any one person. So, I know Louis is incredibly generous. He could give all 5 of us $15,000, right, and anybody else, and so on and so on. So it's not that it's a limit of one person or 2 people. It's, it's as many people. It's just a dollar limit of $15,000 a piece. Yeah. One of the other things that can be done with that on that same line is if people have grandchildren who are already in college, you can pay the educational cost for college for your grandchildren, and it's not deemed to be a gift. And it's also not reclaimable if you should pass as far as in contemplation of death. So it's a nice little thing for people who have grandchildren who have the money and want to help. But just another way, to reduce potential estate taxes.
Anthony, what is the income to get that $10,000 deduction?
It's $200,000.
$200,000.
200.
You're phased out above 200,000. All right. So we made a comment and alluded to it previously, right? But this is something that I've been talking about. I know Lou's been talking about it quite frequently over the past several months, and certainly we'll continue to talk about it for the next 4 weeks. So everyone, I don't think there's anyone on this call today that would say they don't think taxes are going to increase at some point in the future. I mean, if you do believe that, then I need that lottery ticket that you're purchasing today too. But everyone believes that taxes are going to go up. So if that holds true, right, wouldn't it make sense to pay taxes today to save them in the future, right? So kind of seems counterintuitive. We're talking about how to save on taxes, and now we're giving you strategies that may, that may cost you more in tax, payments for 2021. This strategy is a Roth conversion. I'll talk about the backdoor in a second, but I've been talking about Roth conversions for these past couple of months because, you tax diversify your future, right? Everyone's got traditional IRAs. Everyone has 401ks. They're the most, everyone knows what they are. They're pre-tax contributions. You pay tax in the future. The theory is that when you retire, you're in a lower tax bracket. Maybe that is true. But many of our clients end up in a higher tax bracket when they retire, number one. And number two, we don't know what tax environment we're going to be in when you retire, right? So, this all relates to politics and, what type of administration we have when you retire. That'll dictate ultimately what type of tax environment we're in. So, tax diversification is just like portfolio diversification. You want to have some taxable assets. You want to have some tax-free assets. So consider a Roth conversion. If you're not, it's something that we should at least have a conversation about and discuss whether it makes sense. It might not, but maybe it does. And a Roth conversion is taking, traditional IRA assets today, right? Converting them to a Roth IRA so that in the future, you now have tax-free income. Nobody can tell me that they don't like tax-free income in the future, right? It is just one potential strategy to consider. I'm not saying it absolutely makes sense for everybody, but what I am saying is the conversation is at least warranted. And it might make sense to have that conversation before the end of the year, because the reality of it is everyone on this call believes that taxes are going to go up at some point in the near future. That's number one. Number two, the backdoor Roth IRA. So for individuals that either make too much money or for whatever reason, they are now phased out of a direct Roth IRA contribution, or maybe you're, so you cannot make a Roth IRA contribution for 2021 for whatever reason. What you do have available to you is something that we call the backdoor Roth IRA. And I tell you, the current administration is trying to eliminate this. And if and it might be something that does get eliminated moving forward. I don't know, but it is on the table to be eliminated. And what a backdoor Roth IRA is making a non-deductible contribution to a traditional IRA. So you're taking whatever the number is, 6,000, 7,000, making that contribution into your traditional IRA, not deducting it, right? And then immediately converting it to a Roth IRA before any interest and gains accrue that would cause a taxable event. So it enables you to put money in to a Roth IRA when technically you are not eligible to contribute to a Roth IRA. I think you're on mute, Mike. I know he wants to say something, but he's on mute. Oh, no, you're good. Okay. All right. Last but not least, again, not necessarily something that would absolutely save in tax dollars right now today, but this is something that, again, is tax penalty prevention, right? So a lot of people recently were advanced their child tax credit payments, throughout the year 2021. I don't know, and many people were receiving checks or direct deposits into their checking account of up to $300 per month per child for children under the age of 6, and up to $250 per month per child for children between the ages of 6 to 17. But we all know the IRS makes mistakes, and we all know not everybody is eligible. So if you are not eligible and you did receive those payments, and again, this might be for your children who have children as well, make them aware that if they did receive these payments and they were not eligible to receive that advanced child tax payment, all that money will be required to be paid back come tax time when you file in 2022. So if you receive, let's say you had 2 children and they were both under the age of 6, and somebody received $600 a month for 6 months, that's $3,600. That's an additional amount that they will have to repay when they file their 2021 tax return. So just something to be aware of. Very simple. You can check, they started making these payments in July. You could have, if you don't have children under the age of 17, maybe your children do. You might want to tell them to check their bank accounts and make sure that they did or did not receive these payments, and then ask their accountant to verify whether or not they are eligible or they are not eligible to have received those payments.
just with that, there was actually a method where you could elect out of receiving it. Because what it really is, for somebody who is eligible, it's a refund that you got earlier than later. So a lot of people anticipate getting a refund of thousands of dollars based on these credits, and then now they got it in advance, they spent it, then they go to do their tax return, and I'm not getting this, I'm not getting a refund. Why not? Well, you already got the money. So it's kind of a double-edged sword. You either you get it once, you don't get it twice. So my apologies. I had someone from my office on. We're doing a lot of work right now on the new infrastructure bill. Very, very crazy. But anyway, when you're talking about Roth IRAs, let's just go back a second. Some of the real advantages. Like you said, they grow tax free. During the entirety of the Roth. When you take it out, it's tax free. But there's no requirement on an RMD on a Roth, right? When we die with Roth, we all die eventually. If you die with it, it gets passed to the eventual beneficiary. They don't have to pay income tax on it because it's a non-taxable entity into of itself. So it's a little different than everything else. If you have an IRA and your spouse has predeceased you, where you're now leaving it to your children. Once that happens with a taxable IRA, they now have to start paying income tax on it over the next, it's either 5 or 10 years, depending on which rules come into effect. So it's really detrimental. Whereas if it's in a Roth, well, they can take it, but they're under no obligation to pay tax on it. So it's another true advantage. The backdoor Roths are great. I've been doing it for years. I encourage clients who have the cash to do that. So just one of those little things that Anthony is fully aware of, and will helps as necessary.
Michael, I have a quick question, Anthony.
Yeah.
The 20% or the $20,000 that businesses have been allowed in the last couple of years, does that apply to 2021? Is still in effect?
The 20% pass through you're talking about?
Yeah.
So that would be certainly be a Mike question.
It would, and honestly, I don't remember if that was eliminated or not. But if you give me 1 minute, I can tell you.
You don't have to look it up now. You can tell me off, but I just, if you knew, because obviously it's getting close to the end of the year, and you want to know what you need to do with additional income potential.
So I'll throw one other thing out there. This is not necessarily what we would call a year-end tax planning tip, but rather a all year long tax planning tip, because the overall process does take quite a bit of time. But this is something that arguably is near and dear to Jeff's heart, for business owners, right? For business owners, and the ability to purchase long-term care insurance through the business and receive a deduction for it. Something that obviously is a necessary element, right? So, the need for long-term care, as you get older, it doesn't get less. I mean, arguably it gets increasingly more and more, and the cost as you get older gets increasingly higher and higher. So if you've ever looked at it, or if you've never looked at it, certainly at some point throughout the rest of 2021 and 2022, it might make some sense to consider looking at the purchase of long-term care, especially if you're a business owner, because there are some deductions available for the premiums that you pay.
Right, up to $2,500 per person is allowable as additional medical insurance. So that's an advantage. And again, if you're self-employed, it goes above the line rather than into Schedule A. So it's a true advantage. The answer to your question is, Jeff, yes, it was not eliminated for 2021. So you'll still get it.
Thank you.
Let me ask you, Lou, do you think that there was anything that we missed, any other strategies that you're implementing and utilizing that we didn't talk about?
No, I mean, the only other thing really, I mean, even, as a final strategy, if there's money that you're socking away for retirement above and beyond, I mean, there's always the non-deductible IRA contribution. You don't really get a deduction for it, but you do get tax deferral, which is, better than nothing.
Right. Well, that's how we tend to push for the backdoor Roth.
Right.
So that's always been a great estate planning tool for people for years. One of the other things I tell, if you have your own business and you have children, nothing says you can't put them on the payroll.
Oh,
So
yeah.
you give them a little bit, $5,000, $10,000, something like that. Then you can max out a Roth IRA for them. So there's an advantage there as well. So just another thing that we've done for clients for a lot of years.
Now, Mike, is there a limit to the amount of money that can be put into an IRA on a non-deductible basis? Like, can a
Well,
client?
it's the same. The IRA limits are the limits. It's $6,000 per person,
Okay.
plus $1,000 catch up for 50, anyone 50 and over. So that doesn't change whether it's a Roth, whether it's traditional, whether it's a non-deductible traditional. The limit's the limit, right? So, so that part doesn't change.
Okay.
It's for business owners. That's where you have the different plans really come into effect. Whether you use a SEP or a simple IRA, or if you have any of the plans that you had mentioned earlier, a defined benefit plan, defined comp. There's all kinds of different plans that are available, but they're really geared towards a business owner. Someone who's W-2'd, well, max out whatever the company is going to allow. Again, provided you can afford it. But at the very least, if the company puts a 3% match, then do 3%. You're getting 100% guaranteed return on your investment just by doing that. And then you have a choice. If you wanted to do more, you could do more, or you could use the backdoor Roth, that. And also some of the 401k plans right now have Roth provisions in them. So you can say, okay, I'm going to max out my, whatever the number is, $20,000, but I want half of it to be deductible and half not. You can do that as well. Also, some of the plans are deductible for New Jersey purposes, some are not. So, for example, a 401k is deductible. An IRA, simple IRA, is not deductible. If you're a teacher, the 403b, not deductible. So, you have to look at that as well and see if there's a benefit, how far does it extend?
Well, what happens in a situation where, like, let's say you have a retirement plan that is deductible in New Jersey, and then you end up retiring in Florida or a different state? I mean, what happens?
You win. You win. The federal law on all pensions, and it doesn't matter whether it's a teacher's pension through the state of New Jersey, or you were in a university and you're a TIAA CREF, or IRAs that I put away through you guys, doesn't matter. All retirement plans are only taxable to the state in which you live when that withdrawal is made. So if I put away millions of dollars into retirement plans while I'm a resident of New Jersey, New York, or any higher tax state, and I got the deduction, I now move to one of the 9 states that don't have tax, Florida, Texas, Tennessee, Washington, Wyoming, one of the Dakotas, New Hampshire, Nevada. Yeah, I'm missing one. Anyway, to any of them, now I take the money out, I win. No state tax. Now, one thing that's a little difficult but can be done, you take somebody who's accumulated however much money, and they say, we're moving to Florida. And they do everything they have to do. They change their residence, they change their voter registration, they change their bank information, they change their driver's license, they buy a house there, they sell their house in New Jersey, do everything. And they say, you know what? I'm now going to convert my IRAs before I take out my 401k. I'm going to convert them to a Roth. They do that. They now avoid state tax. A year, 2 years later, they move back to New Jersey because they really don't like, 130 degrees in the summer. So they say, I'd rather deal with the winter than the summer. Well, they've now converted that state tax free. And then when they take it out later on, it's again tax free. So just a way that you can actually beat the system, but it requires moving to one of those states, for at least a year. And so, New Jersey's, 6, 7, 8%. If you're higher, even better. But just one of those, little games that can be played.
Okay.
The tax game. Kick the can down the road or avoid
is.
it altogether.
Yeah. Well, I always tell people that there was a U.S. District Court justice by the name of Learned Hand. And to paraphrase, he had several, but he said, it's everybody's duty as an American to pay the least amount of taxes possible. But he also said that, there's two types of taxes, one for the informed and one for those not informed. Both are legal. Better to be informed. So just, something else, that we look at.
Mike,
Okay.
one just like a side, actually, just outside the investments, does it make sense with the pandemic and everything, taking a deduction, for a home office, charging yourself rent type of thing, or does that
The answer is sometimes. Not everybody's allowed to do it. For example, I cannot. You guys cannot. Because your company, my company, provides me with an office. And now it becomes a personal choice for me to work at home. Okay. So the answer is no. Jeff, on the other hand, works out of his house. So he will deduct the relevant percentage based on his expenses for his house. So that would include real estate taxes, mortgage interest, homeowners insurance, any maintenance for the house, including landscaping, snow removal, electrician, and so on and so on. Right? So it'd be pro rata. So if his office is a 10 by 10, only 100 square feet, his house is 2,000 square feet, he's going to write off 5% of everything. However, one add-ons is that if he does stuff to benefit that office, he repaints, he carpets, he buys a new desk, he puts in the shelves that you see behind them. Any of that is immediately deductible and at 100% because it's for that space. So, now one of the real negatives with home offices for people who work in New York or their employers in New York, and in theory, they are provided a desk in New York. If they work at home, they still have to pay tax to New York. You can't say, oh, well, I work in New Jersey. There has to be a bona fide office in New Jersey for that to happen. So it's just kind of a catch-22 that we're in, for anyone's working at home, even though they're a New York employee. But
So
we
what
said,
you're
well, what
saying
happens if? But no, you said something else. What happens if we pay rent? Okay, you have to pay fair market value rent. So you say, okay, that same office, your office 10 by 10. So what is the value of that? Well, you say, okay, well, let's just say it's $18 a square foot. You're going to only pay, whatever it is, $1,800 for the year. Can you do it? Well, yes, but now you have to pick it up as income and you have to declare that percentage of your house as a rental property. And when you do that, you then could have future tax considerations when you sell the property. So it creates a whole different world. So you have to kind of balance it. It's not the easiest thing to do.
Okay.
So when you need a new roof, you need to make sure that the roof is leaking in your home office.
Huh? Yeah,
Because now it benefits your home office.
it does. And by the
and you get to deduct the whole amount. That's it.
I actually need a roofer if anybody knows somebody.
Just go up there and put a hole in the roof.
Yeah.
All right. Well, this is good. I just, look, I want to keep everybody on time. I certainly value Mike's time, and we appreciate him being here answering any of those in-depth questions. Jeff, I wanted to see you had any more questions, any comments,
I just want to thank you and Louis. It was well done, Michael. Thank you. And I appreciate it.
Sure. Anytime.
Yvonne, how about yourself?
No,
You good?
nothing.
I got the
myself.
thumbs up. And then Lou, how about you? It's good to go as well. All right. Well, look, if there's no further questions, we certainly appreciate everybody being on the call today. And, look, our door is always open. Whenever you have questions, do not hesitate to give us a call. If you have anything that's a little bit more specific and in depth and we need to bring Mike in, we'd be happy to do so. And until then, I wish everybody a great holiday season moving forward. And I look forward to speaking with you guys more in the new year. Thank you very much. Have a great day.
Thanks, guys.
Enjoy the cold weather that we have out there.
Yeah. Not for long. So, Anthony, if you wanted to stay on for a minute, we can compare calendars.
Sure, guys.
Yeah.
Thanks again, Mike. Appreciate it.
No problem, Louis. My pleasure.